What's going on, everybody? It's Spencer Gray, host of The Gray Report. We've got an exciting episode today. So, whether you are a current multifamily investor, you're trying to figure out this whole real estate investing business, or you're already in the multifamily apartment industry, this is the show for you, really keeping you up to speed with everything you need to know that's going on in the multifamily industry, kind of real estate in the economy. Help you really make some really good decisions. Again, if you're looking to make an investment or you're just trying to, build up your knowledge, for your own business, for your own company, for your own career, we break down all the latest research reports, news articles, data sets, trends, opinions. Again, focus on the multifamily industry, but everything that kind of touches it, including general real estate market and the macro economy itself. We've got some really interesting reports, a great report from the Indianapolis, Cushman, and Wakefield team on the Indianapolis market itself. We've got a good national report from Apartment List, but then also some news from the Biden administration and, what's going on with this Omicron variant, inflation, and that macro story that we've been covering pretty consistently. All right, let's just get into it. All right, once again, Matt Bosnagel, Director of Communications and Marketing here at Great Capital. Matt, it's a little bit of a cloudy day, but how's your week going?
It's going pretty good. There's always some interesting things. There's always, at least in the multifamily market, it seems more normal than I would expect. But again, I'm getting more nervous about Omicron. So,
Some people are. I think there's a lot of unknown. I'm not as nervous just because I don't think we know, and I'm just not worrying about the things I don't know enough about. I can't control, but I think it's definitely worth paying attention. And Matt, to your point, I think earlier, I think it's interesting. Early last week on Tuesday, when we recorded the last episode of the Gray Report, we were talking about coronavirus picking up and what that's going to potentially do to the economy. And then we saw on Friday, stocks take a major hit. Not that we necessarily predicted that was going to happen, but we were really kind of talking about this, I think, before it really started making headlines. Now, were we talking about the Omicron variant? Maybe not, but give you credit either way. So
yeah.
Good job. Okay, so I wanted to, before we kind of get started, we gotta mention one great resource that, again, if you were at all interested in multifamily apartments, that's the Gray Report, grayreport.com. It's the home of the Gray Report, and it is a incredible tool to keep you up to date with everything that's going on in the multifamily industry. We're aggregating all the latest research reports, articles, and we built this as a companion to the Gray Report newsletter that you can sign up on the grayreport.com. And that it's a weekly newsletter. It gets written up all the time, a lot of great reviews. We figured, let's keep people updated every single day, but let's not bother them with an email every single day. Let's make a website that aggregates it. So it's the premier multifamily intelligence aggregator. Check it out at grayreport.com. Okay, Matt, let's get just right into this apartment list report. And these come out once a month, really kind of monitoring what's going on a national level in terms of rents and multifamily markets. They also do they also do local reports as well. And so we were looking at one for a lot of the markets that we invest in as well. But I think this echoes what we've reported on the past couple of weeks, is that we're seeing this return to a little bit of normality and seasonality with a slowdown in the growth rate, which I think is very healthy, because we would not be able to sustain the level of growth we've seen kind of starting in March of 2020. So I see this as a relatively good sign and normal sign, and you can really see this in this chart. And we've featured this chart before, where we've really we've removed ourselves from the normal kind of trajectory in path that rents had been on. We can see this comparison to where if we had followed kind of normal trend lines of national median rent, but what of the pre-pandemic trend line to the new trend line, and you can just see that slope is significantly steeper, and that's all the rent growth we've seen. But again, rent fell this month or last month in 53 out of the 100 largest cities, and including some markets that had seen some of the highest rent growth. including
Yeah.
markets like Boise, which
So,
again that makes sense.
and that's something that I think we have noticed, if not talked about it on our newsletter, is a few months ago they were talking about places like Boise and Tacoma as as these places where rents were maybe a little high. Now they're just going back to normal. They're still over for the full year. They're doing great.
Yeah,
But things are turning to normal, and it is interesting that in 2019, which is the comparison year that I'm still using, in 2019 rents dipped a little bit during for seasonal reasons, and we had a slight amount of rent growth still. So it's not like we're even fully returning to normalcy. We're just a cooler, we're not hysterical. It's not
exactly.
unreasonable or rational. This is good for investment because it seems like we'll be able to predict and think about things without that breathless rise,
Well, yeah,
rise,
what's
rise.
what's going to happen? It's just so
Yeah,
unknown. It seemed a little bit familiar, I
yeah,
guess, is the way I'm seeing it. And same with vacancy. We've seen vacancy pick up just a little bit. Again, still significantly way below where it has been, historically. We're still at 4.2 national vacancy. That's crazy. But again, we can't keep decline vacancy. Can't Well, I guess it could go 100%. We've seen that in some apartments, but that's just not reasonable to think. But it is reflective of just looking at this past year, just how tight the market is and the demand for housing in general.
yeah. And this is something that you clued me into, and I said this last month, or during the apartment list. They have this great map that gives the city level rent estimates, and not just city level. You zoom in and you get
A lot of submarkets as
you get the
well.
submarkets,
Yeah,
and these
take a look.
submarkets are real. This is what rewards. This is one of my favorite aspects of digging into reports, is you find things that maybe escape people's attention. And I'm not saying that people don't know what's going on in their markets, but I am saying that there are a lot of popular competitive markets in the Sun Belt that that maybe it's worth looking other places. And yeah, you can get the credit for finding some of these submarkets,
Well,
especially.
I think to your point, yeah, it's worth not always just looking where everyone else is going,
Yeah,
because there's some, again, the Sun Belt has some absolute incredible markets with just awesome fundamentals, so much migration. Um, but then there's some markets elsewhere that are seeing different fundamentals, different ratios of fundamentals in terms of supply and demand. Maybe there's not as much demand, but the
yeah,
supply is so much lacking. It's creating all this growth. For example, looking at a very popular market for multifamily investment, Atlanta, Georgia. Now they've had very incredibly high, record breaking, rent growth since March, 17.9%, basically 18%. But there are some of these markets, for example, Carmel, Indiana, 30% rent growth. I mean, that's almost double the rent growth over the last year that you've seen in Atlanta.
yeah.
Now there are other high flying markets, and I guess that's similar to Phoenix, which is
Hmm.
crazy. And you've seen, but that's, now there are markets like the Bradenton, Florida, that's grown 52%. So now there are some crazy markets out there. In Florida is no exception, but even Fort Myers 30%, Naples 46, Miami 21%, Boca Raton 38%. So yeah, but we don't want to go through every single market, but I highly recommend hop on an apartment list, check out their reports, and if you don't have time for that, again, if you're subscribed to the Great Report newsletter, you're going to get these reports emailed to you every week anyway, or as they come out. So definitely check it out, and good job, Apartment List, for putting these all together.
Yeah, we really love you, apartment list.
Hmm. Okay, Matt, I want to take a look at the Cushman and Wakefield report. So
Yeah,
I went to kind of the state of the market presentation that the Indianapolis Cushman and Wakefield team put on. It was about 2 weeks ago, I believe. It's a very well attended, look forward to event that typically takes place every year. It's put on by the Indiana Apartment Association, and George Tickashan, which is the a partner and lead broker over at the Indianapolis Cushman Wakefield, formerly Tickashan Associates. He's given this presentation now for I think over 2 decades, every year tracking the Indianapolis market, in the Indiana market, and he keeps not only his access to all the Cushman Wakefield, their information, CoStar, Yardi, these data points. He also keeps his own data. And from he has some same store information that he's been tracking, a collection of like 30 apartment complexes around Indianapolis to compare the same assets year over
Yeah.
year. And so a lot of different methods, and he has more data, more
Hmm.
granular information, and so it's much more granular look into the Indianapolis market in most markets, and you're able to see. So this is going to be available in the newsletter as well. But
Yeah. I,
let's run through it. But yeah, go ahead.
just kind of you were covering before we cover the information itself. It is worth mentioning how good this report is and how much data they recover. And it's almost Cushman and Wakefield doesn't present this on their national site, so it's a little bit, you have to know where the information is, and that's part of why we do this, is we provide this information for you. But this is one of these cases, especially where someone like George Tickashan, he has that information. You can't just download his brain, but he has all this information on all this knowledge, and it's great that he's sharing it in this report. But it is also a reflection of the relationship driven aspects of the multifamily industry. You're never going to know every 100% of what someone else knows. You can't just put that in a report, but by building that relationship, they'll be able to tell you some things, and they'll be able to give things like those presentations and stuff. And so it really does. And not to mention Zillow again, Zillow maybe tried their AI to get knowledge of the real estate market, but sometimes the human brain and running off of relationships can really deliver that information and prioritize things and figure out where the market's moving maybe a little bit faster sometimes than hard data.
Yeah,
Just
I think.
interesting.
Yeah, no, I think that's a good point. I mean, especially working with brokers. I mean, and whether you're working with apartment owners, it's so much about relationships. And it's true, and that's why one of the reasons why we started doing the Gray Report, the newsletter, is that we really thought that there's a lot of great information out there, but it's not very well disseminated, and it's kind
Yeah.
of hard. You really have to look for it, and stuff that if you really weren't paying attention to, you're going to be at a disadvantage. I was always surprised that when I was having conversations with big apartment owners, people in this industry, they hadn't really read the past couple reports. They didn't know where absorption was, how many units were coming online, what the pipeline is. I mean, they maybe knew some pieces of information from their relationships that were that are invaluable, but they weren't necessarily getting the full picture. And so we're like, well, let's put all this stuff together. So let's take a the report. Now, the first part of this report, and it's a decent size report, is really kind of getting into the strength of the state of Indiana. A lot of people, they don't think of Indiana as one of the better apartment markets to invest in the country. But there's a lot of these unique dynamics that we find make it a compelling investment opportunity. A lot of it is the business friendly nature of Indiana. It's very landlord friendly, relatively simple, property tax state. When we look at other markets, even in the Midwest, I mean, look at this, kind of state business climate piece down here where, we're the ninth best tax climate. When we look at, Ohio, especially Illinois, there's a lot of issues and reasons why we don't invest in Illinois. But Ohio, has some great markets, but the property tax regime is just so much more aggressive. It's harder for us to go to Ohio when we've got just a much more friendly, property tax regime, locally in markets that we know even better. So, obviously the bond rating, job growth, it's a lot of good things going on. Let's take a look at actual rents in Indianapolis, and they've broken it down, not just the whole city, but by submarket, but also by the class of assets, broken down by bedroom. Because you can think, okay, I'm going to invest in Indianapolis, average rent of 1,023, but you're buying an apartment on the east side of town with an average rent of 791. That's a big gap.
Yeah.
And if you think that if you're looking at your average at 1,000, you may be kind of missing the actuality of, again, just that hyper local information.
Hmm.
And so if you don't have this information, you don't have, actual knowledge of the local environment, you could easily make a mistake. Now
Yeah.
downtown, still highest rent in the submarket, even though we didn't see the rent growth last year, 1,290, almost $1,300 a month. North of Carmel, though, Hamilton County, Fishers, Zionsville, still over $100 away, but 1140 basically on average rent. We've seen a lot of growth. That was that 30% rent growth that we'd mentioned from the apartment list report itself. So, Matt, any of this surprise you at all? Just being an Indianapolis native.
I wonder about especially with Carmel, and you talked about that in terms of the rent growth with the apartment list report, but also, seeing these high rents in general. I wonder how much of it is associated with Carmel building up into, for lack of a better word, one of the reports called them the vibrant suburbs. But these little, these kind of miniature cities, they're recreating a kind of downtown atmosphere
Yeah,
with taller buildings and I think
luxury
higher. Yep.
luxury apartments with higher rents.
Yeah.
Uh,
So I think that we're going to see that in a lot more submarkets as they grow in the periphery of Indianapolis. But, that's not to say that it isn't happening in other Midwestern cities and other
Oh,
cities in
100
America too.
percent.
So,
A lot of different
yeah.
suburbs. Yeah, 100%. Um, and I think that it's a good distinction and something to keep track of is how much is this rent growth from the is actual like growth from existing assets, and how much of it is just new apartments
Mm,
that it costs more to build, and so you have to charge higher rents.
yeah.
And that is where, I'm going to bring up this next page, and that's
Hmm.
where this report is unique, is that it tracks same store rent growth. You don't usually see same store rent growth in multifamily reports because they just don't keep the data on specific assets. Again, George Tickishon, Cushman Wakefield, he's been tracking the same assets from the same owners for years. And so can you see a lot of same store rent growth in like in retail real estate a lot? You see it on apartments. And so this actually gives a little bit more information on what's kind of going on into your normal apartment community, not brand new construction. And 1 year annual growth is 7%, which is still a huge number. But then it breaks it down not only to just last year, but the last 5 year annual same store rent growth is 4.7. And then if you really break it down to a 20 year, it's a little bit lower at 2.6, but the 30 year is 3.4. So I think when you're projecting and when we're projecting, okay, what's our kind of organic rent growth going to look like over a multi-year period? It would be a mistake to assume you're going to have 7% rent growth every single year. Maybe we'll get at this. Maybe we'll get in 2022, 2023. That's what most data firms are projecting right now. But if we stretch that out to, kind of the 5 year, the 10 year, probably that 4% range is going to be more appropriate than that 7.
Hmm.
And so that I think you're not going to really see this type of data set anywhere else. And you see the average rent growth rate, and this is in reference to market rents. That's where we see this much higher, 8.8, and it's actually closer to I think 12 or 13% in Indianapolis. So I think this data is just slightly outdated. Just because things have moved so quickly from the time they actually put this together. And another theme of this report is that there are a lot of pictures of assets being featured. We won't necessarily say the names of them. But we made a good run at quite a few of these assets. We've bought quite a few properties from this team. It's a great team, but is that like
Yeah.
familiar? Is that like familiar, Matt?
Yeah.
Does that like familiar?
And there's a lot of memories in these reports. And this is another thing too. Think about all this information just for Indianapolis, and then you can't replicate it, without knowing where to look. And because it's like going into the library, you have to know. You have to find a librarian. You have to find someone that has access to
Yeah.
that information and is able to prioritize. And that's, I think, a lot of where that relationship-driven aspect is.
And I don't think you don't assume that all this information is going to be in an annual report. Like
Exactly.
you don't
This is
usually,
this is the
so
wealth.
it's easy to kind of ignore it. But I mean, and there's too much on this report for us to cover today, Matt. But just Indianapolis downtown development. Well, this is actually Northside Carmel downtown development. What's coming online right now? What
Mhm.
exists? So if I highly recommend if you're all interested in the Indianapolis market. Um, you know, if you're subscribed to the report newsletter, you're going to get this. But if not, hop on over to the Cushman Wakefield website. Or
I
I guess you could email Matt.
Yeah, it's here.
Matt,
I will get it to you.
Matt will send it to you.
Hey, let's build a relationship. That's fine.
We like
I,
getting
I
personal.
did want to highlight on page 18 of this report, it
Yeah.
talks about the sales activity in the Indianapolis metro, and you see this big rise from 2020 to 2021. You see the average price per unit. It's roughly correlated, the transactions and the price per unit in square foot, and then the
Yeah.
cap rates are kind of, this is all really proportional to each other. I think it's very interesting where things are moving, and just looking at it through 2020 or through 2012, where they're measuring, there is a general progression of greater sales activity. There's some bumps in the road, but it does seem like sales are picking up in general. There's a real trend.
And this is something I remember Hannah on from Cushman and Wakefield was really talking about this. I remember talking to the Cushman Wakefield team even prior to their presentation, but I think Hannah said that more than a third, or maybe like half or
Oh
three
yeah,
quarters of all of their transaction activity in 2021 is going to take place in December. Not just like fourth quarter, just December. And so we were almost basically exceeding what we do a volume in a normal year, but then most of the volume is going to come, has yet to occur. That's a lot. That's a lot of volume. We're almost going to be doubling our typical sales volume. And
yeah,
what's driving that is, there's kind of a confluence of two factors. One, there's a lot of attrition. Owners are getting older, thinking about retiring. They're
Hmm.
seeing the market. They never thought in a million years they'd be able to sell these assets at these prices.
Yeah,
And so I throw in a third thing is the idea that, okay, I'm going to lock in capital gains tax rates today, what I know they are, versus the fear of them going up.
hmm,
Why not take the win right now? I'm thinking about retiring, make a huge amount of money, lock in a lower than potential tax rate. Okay, I'm out. So I think this creates an incredible opportunity. Now prices are high, which gives us some resistance, but again, we're seeing all of this growth, and we've talked about this growth really narrowing the gap between effective rent and market rents over the next couple of years. We're going to have 2 to 3 years of really solid same store rent growth, effective rent growth, not market rent growth. I think we'll get a little bit of more market rent growth, slightly elevated, but the crazy 20-30%, that's in the rear view mirror. We're not going to
yeah,
see that anymore. But there's going to be this catch up, and there's going to be a lot of markets who have now realizing, smaller markets especially, are like, oh, rents everywhere else have risen
hmm,
20, 30, 40%. Oh, we need to start raising our rents because all of our costs of everything has gone up anyway. So
yeah,
yeah, no, thanks for mentioning this piece, because I mean, just look at the average price per unit. Now, this I think is only looking at Class B or better. So if you're looking at kind of 1960s, Class C assets, you still can pick stuff up for, call it 75K to 100K a door. So half the price of kind of B or better. Um, we're picking up 2005, B plus A minus asset in Bloomington for 116 a door, Matt. So we're
yeah.
definitely,
Okay.
so are we getting a great deal? Or some people paying up?
That's and again, it just rewards legwork,
Mm,
and building the relationship, and also getting the information and being able to really just take a walk and go there yourself. You kind of, yeah, it just rewards the work that you put into it,
yeah.
and looking into some of these, because like I said, the opportunities are there. I've said it clumsily, but it does. If you're willing to look for it, there are places that'll.
Yeah. And it may just take looking at things differently. You
Mhm,
can't
yeah.
necessarily look at acquisitions in 2022 now like you were in 2019 or 2020. In 2020, we didn't know what what to do. We are just like, okay, what are good assets?
Yeah.
What do we think we know is going to be a good asset in the future? 2021, it's like, oh, okay, the floor didn't fall out. These are some incredible opportunities. The market's still good. Everyone started piling in so much.
Mhm.
Everyone has so much money. And then all of a sudden rent started growing 5%, 10%, 15, 20, 30%. market rents, and we're like, this is some crazy inflation, and where this is going to go over the next 2 years. Just there's been a lot of clarity. I wouldn't have near the clarity, and I don't know we don't know everything. We don't know what's going to happen. First step, we got to admit ignorance. But I feel like we are able to navigate and mitigate risk and quantify risk and
Yep.
there are things we can quantify and know. And if you're not tracking the market, if you're not listening to the Gray report, every week and reading in the newsletter, it's hard it's hard to have that clarity. Look, here's Bill's on fur down here
Yeah,
at the
I
bottom.
was gonna say, look at page 19 has
Mhm.
some familiar
Yeah, a lot
sites.
of familiar. Okay. Well, good job. We really appreciate all the work Coach Wakefield does. Again, we
Yeah.
like the whole team over there very much. Okay, so Matt, let's start getting a little bit macro. Still on
Mhm.
multifamily though. Biden administration, rental assistance.
Yeah.
Why hasn't it gotten out? I'm behind a paywall,
I
so you're gonna have to fill me in.
So okay, so the long and short of it, and this is the kind of paragraph that I pulled out. It says the officials said they couldn't specify which jurisdictions would lose and gains funds for rental assistance. So it looks like they're moving funds from places like Montana and North Dakota, and then local officials in several more populous states like New York and Texas are expected to exhaust their rental assistance money over the coming weeks and months. And the figure here that they give is about $800 million that they're moving from state to state. And I've been so used to saying trillions and billions that 800 million is still a lot of money. I think what it really represents is this earlier discussion that we had, that the government's not giving up on rental assistance, and their increased attention to the bureaucracy apparatus, the infrastructure, whatever you want to call it, this system of rental assistance, they are paying more attention to it, and which could be a clue to its longevity in the future. This could be a system that they redeploy, and it just raises a lot of questions, and there's a lot of implications for the multifamily market in
Yeah.
the future. It may just be limited to affordable housing, but I'm not. It is definitely a can of worms, and it is certainly something that people should watch in the future.
No, I think, I mean, how many entitlements and social safety nets that have been erected get removed?
Yeah,
I can't think of any off the top of my head. I mean, taxes go up, taxes go down, but these safety nets don't typically go away,
yeah,
especially now that you've got, there's probably data saying that so many people did not, die or didn't go into poverty and didn't become homeless because of these programs. Whether you take all the, any, if any, unintended consequences, and and just
Well,
sure, you can take issues, but there's enough evidence there of where people are going to be scared
mhm.
to take that away. It's not going to happen.
Well, it's very, and we said this in discussion with the eviction moratorium. It's very easy to see the direct impact of, of someone needs rental assistance, you're giving it to them, they have someplace to live. Whereas if you're talking about like maybe not using that system, and it's a little bit more indirect, where people may get, like we said, the occupancy was higher in some of these places where eviction moratoriums were less strict, and so there may be more people living in a place or living in rental units than there are without government intervention. So it's just the
Hmm.
lack of government intervention is a little bit, it's a more indirect effect, but so it's easy for people to maybe understand if
Yeah.
you're giving them direct help.
Yeah, I think looking at the two programs, the eviction moratorium and the rental assistance, I think most would look at the eviction moratorium and it just being a failure, and just it did not achieve, no, it was unclear of what it was even supposed to achieve, and it was much more confusing than anything. And I haven't really been able to find any proponents of it other than people who are just like, you shouldn't evict people in
Yeah,
general.
it's way easy. And I don't want to evict. No one wants to evict people, and it's
Yeah.
so. And
Well, but it's
then
like,
the yeah,
how do we, or what we run the whole, our business.
yeah.
And it's like, because this is how we provide housing, we do it through private market. If you don't allow private markets to work, then so, but going direct seems, people can point to that, owners and people, whoever, are saying, okay, well, I can see a direct effect of that working, on the ownership side. Okay,
Mhm.
we're going to have to evict this person. Like you said, we don't want to evict them. They were able to get assistance. great. We don't have to go through an eviction. That's
Yeah,
awesome. That
yeah.
we spend less money. We get to keep an apartment filled, and they're paying. Are there issues with it? Like, sure, but it's a net positive.
It's definitely better than the eviction moratorium. I think what you said earlier, this was about a month or two ago when Janet Yellen was mentioning this in some of her remarks. It does raise some doubts and uncertainty about what the risk is and what the returns might be in the future. If people can rely on rental assistance,
Mhm.
then it's a much more automatic kind of thing, and there's less risk, and maybe it might be less profitable of an investment. But I do think that it's a lot less onerous than an eviction moratorium.
Yeah, and yeah, again, are there? I think there probably will be unintended consequences. Are we skirting personal responsibility? But again, this isn't. It's the people who can qualify are not people who've decided not to pay, because those people aren't going to even go look for rental assistance. Those people are going to continue to be evicted. These are for people who are hardworking people for the most part, who've lost their job for whatever reason, and they don't want to be kicked out of their home, and they're looking for a job elsewhere. So are there is it creating some kind of moral hazard of you've signed a contract and you pay and you don't have to, and are some people going to say, I don't really care because I'll be able to apply for rental assistance.
Yeah.
Probably on the margins, but like certainly yes, there will be people like that. But
Yeah, I don't think
we're
that
here.
they're, yeah, exactly. I think that it it's a thornier issue and than people realize. And I think that there's a lot of work that good property managers do in trying to mitigate this before it becomes an eviction.
Hmm.
And I think that's the first backstop. That I don't like to imagine that everyone's there trying to evict people, because it doesn't make sense. You want someone in there that's able to pay, and maybe if they, that if you can set up a plan that makes that happen, then that seems a lot better, and a whole lot less heartless than just kind of kicking them out with.
Yeah. The only reason when you want to kick someone out is if they're causing major issues to the
Yeah,
community, and then it's like, okay, you need to go. Now, if they're like, I'm not paying just because I don't want to pay, that's also a reason, okay, to go. But if it's I want to pay, I'm looking for a way to. It's like, well, we would like to keep you around.
yeah.
Maybe we can help you find a way to pay for it. Um, Okay, Matt, let's go into Pal Town. Jerome Powell, Fed
Hmm.
chairman. Sounds like he's retiring this word transitory. Probably about time. So inflation is here to stay. Is that
Yeah,
the story is?
his quote is, "We tend to use the word transitory to mean that it won't leave a permanent mark in the form of higher inflation. I think
Yeah.
it's probably a good time to retire that word and try to explain more clearly what we mean." I think we knew what he meant.
So we use the wrong word is
Well,
what he's
you know,
saying. Is it like a transient that is like it's kind of specific.
yeah, the fall of the Roman Empire was a transient over 500 years.
Yeah. So the definition, if I remember correctly, that they're now using for transient is just non-permanent.
and and
All things are non-permanent.
Well, and what it really highlights is a change in judgment. He's changing the word because the conditions have changed. I don't think that he made a mistake in using transitory before, because I'm sure that they go over the exact wording of his statements. People are hanging on to every word, and so him using that word was
It
not
was
a slip of the
specific.
tongue. Yeah.
So, but I mean, they may have made them. So was the mistake on the choice of wording, or was it the analysis of you know
Oh, I think it was this.
macroeconomy in
I
the
I think it
future?
definitely was. I think that it was an analysis that has changed. And I'm not. I think maybe I think maybe there was a little bit of, well, it might not be transitory, but we're still going to use it for a little while. And now we realize, all right, we can't get away with using that.
Hmm.
I think it was more of a case of like of a reassessment and a realization that that inflation is here to stay, and it's not really doing any good to emphasize that it is,
Bingo.
yeah,
I think that I was just hearing you talk. I'm like, that's the reason. It has nothing to do with the reality, or it's all about communicating and what markets want to get out of it. And if they had come out and said, guys, we don't want one, we don't really know, but strap in because we're going to see some incredible amount of growth in inflation. I
Yeah.
don't know when this thing's going to stop. Markets would take that completely different because even if and there were a lot of people saying when he said, okay, inflation's going to be transitory, it's going to be slowing down. Some people were like, okay, BS, I'm going to take the other side of that. But a lot of people in finance, the economy are saying, okay, well, I'm going to listen to Jerome Powell. They've a lot of smart people over there at the Fed. Some of it I think is we don't know. And so we look to experts and what their opinion is. And maybe I think some of the more institutionalists who are saying, I believe in the Federal Reserve or what they say. And I'm just going to be on their side. It is transitory because I want to trust what the Federal Reserve's saying. And now it's like, okay, well, they weren't wrong, but they were communicating things that maybe they knew were incorrect, which again, it comes back to these guys are setting the price of capital essentially for the world.
Yeah.
And
that's the real thing you got to follow.
Mistakes.
Yeah.
Mistakes can be made.
Well, and my thing that, especially as it relates to inflation, is they have a choice really, and they have this choice between, are they going to encourage growth and employment, and or kind of mitigate inflation. And I don't know, they haven't really put the hammer down on okay, all the employment problem solved, the economic growth problem is solved, and the absence of statements like that doesn't really matter where transitory is at. The unstated thing is there's still some employment catch up to do, and I think that's when we may start seeing movement on interest rates in addition to their asset purchases that they're curtailing.
Yeah, and this thing is a good transition. And because is all of a sudden full employment? Does that kind of then move to, but we want to see wages rise a little bit more, and maybe we need inflation or a little bit hotter to see wages rise. And there may be a little bit of kind of a scapegoat to allow inflation to run a little hotter and to hold back on some of those rate hikes that people have talked about happening time mid next year to 2023, and that is this whole Omicron. Matt, is it worth? I saw a very bad meme. It was conspiracy theory, and there's probably a good explanation, but I just thought it was interesting. Looking at the Greek alphabet, and she or Z XI was like, did we skip that? And is that
we did
posturing? Was there one? Was there like a variant that, or did we just?
What I heard is they skipped she because of the because the Chinese implications.
They didn't want it to be,
and they skipped China. New because it's is this the new NEW variant or is this the NU Greek letter variant?
Confused.
But you know what? Omicron is a cool name.
Omicron is a cool name,
and I'm not gonna forget it.
Omicron,
way cooler than Delta.
Yeah, Omicron variant would be a pretty cool. It could be a good sci-fi movie or a good band name.
That's I keep thinking of the Futurama Omicron Persei, but that's a deep cut. We can edit that out if I sound too nerdy there.
It's fine. That's why we come here. Okay, so the debate on whether the Omicron will make inflation worse. And the first thing I have to say is nobody knows anything. Anything that I've read is all we don't know. We don't know. Like WHO, we don't know, whether it's Fauci or whoever, we don't know. We just don't know.
Yeah.
Some people say, it spreads worse, but maybe it's less severe. People say, kids are more susceptible to it. I don't think we know anything, but Matt, maybe you know something.
Well, I do know that cases were rising before we knew what they were called. And
but not necessarily of Omicron.
Yeah.
But we don't know. But we don't know that either.
Yeah, exactly. And
what are we even talking about?
And so I think that this kind of seasonal rise in COVID cases was going to happen. Now, beyond that, if it increases significantly, if there's kind of a surge, then it may have increased effect. But even still, I don't even know because it says here that investors are betting that Omicron will slow the economy, but also ease inflation. But if Omicron contributes to labor shortages and construction workers or port or dock workers aren't helping ease these logistical problems, then maybe prices could still stay elevated. So, and I know a lot of the reason for there was oil prices could go up. Prices for shipping could still, because people are still buying things, they're staying home, they're not buying services. And if that was the underlying issue with the with inflation, that was the story that at least people were telling. Omicron doesn't seem like it's going to help that. So I'm not really sure where it's going to take inflation.
And we don't have this prepared, but I think there have been a number of studies, including one that came from the Federal Reserve, that basically said that the Delta variant and past variants, besides the initial COVID-19, the Alpha variant or whatever, has not had that much effect on the economy.
Yeah.
I mean, we're not seeing, like maybe in Australia and a couple other places, there's shut lockdowns, less flights from South Africa or something. But I don't think there's going to be less longshoremen offloading cargo containers on the docks because of the Omicron variant. One, again, we don't even know if it's that serious of a variant or not. We don't know. I mean, there's issues, it reacts to the spike proteins differently. Maybe vaccines aren't going to be as effective, but we don't know that.
Well, and I think that makes a lot of sense. And it really reiterates, it's a good counterpoint to the volatility that we saw in the stock market. It's swinging up, it's swinging down, but economically, it may not have had as big of an effect as people were speculating on.
No, it's stock market. There's people who are saying, okay, I'm just going to move back into a pandemic trade. All of the algorithms that are, scraping news articles, new variant, new wave, flights being shut down. Okay, those are similar triggers at the first, when the initial lockdowns happened, similar articles came out. And so we're letting the algorithms just take over to take risk off. But I think it was very there's not enough information to really make those educated decisions. So I think there's probably some overselling. Now it does go on for a little bit longer, because I know yesterday was a rough day in the stock market also. But we're also dealing with what we mentioned earlier, with this kind of the seasonality of things slowing down, and investors maybe kind of reallocating into different sectors. But then there's also probably people saying who aren't looking far enough back and are saying, oh, they were seeing declines. Is this weakness in kind of the value sectors and industrials?
Yeah.
In real estate, where it's maybe just seasonal.
Well, and that's what it really suggests, is if they're going up and down so much on this breadth of news about Omicron, where the impacts haven't really even been seen, then it suggests that there's some vulnerability in the stock market that we're certainly not seeing in multifamily.
Yeah,
but that's.
So Matt, let's look at Gray Report, and let's take a look at, and this is just a feature you can find at grayreport.com on the market stats. If you click this REIT tab, there's the iShares residential sector. That's showing kind of a composite of a lot of the residential, apartment REITs. That probably also has some single family home developers, but you could give us a good picture. We've definitely seen over the past month or so, along with the market and a lot of other kind of value trades, we've definitely seen a decline in the public markets themselves, similar to what we've seen, really in the stock market, but just not as bad. Not nearly as bad. We're seeing a lot of asset classes, crypto may be doing a lot better, but still, it's multifamily is not spared in the public markets. That's one of the advantage of not being in public markets. You just don't have all the price discovery. So it's like, maybe things that may be, if there's just no mark to market. So we don't know. If all of our apartment communities are traded on every single day, we may have seen declines, but not necessarily based on revenue, but just based on investor sentiment and interest and perceptions of value into the future. That's something we don't have to deal with as much. We can make be much more strategic, I think, and stick to fundamentals, which allows us to really be value investors rather than speculators. And technicians, which we are trying to follow the market to see where it is going also, but we're still more relying on fundamentals than anything. So okay, Matt, this was a great episode of the Gray Report. Really appreciate you being on once again.
Thanks a lot. I think next week will be interesting. Hopefully we'll get in a little different setup, so I'm excited.
Should we mention that?
I'm sorry.
We've mentioned it. We've mentioned it already, so I think so. But yeah, and so we are. You may have noticed from previous episodes, Matt is no longer in a dark dungeon like he was last week. But we have new backgrounds because we're in a new office. Still in Indianapolis, we've moved a mile or so away from our offices, right in the heart of downtown. Now we're just a little bit outside of downtown. Really cool redevelopment called the Box Factory. Um, Anytime anyone's in Indianapolis, give us a call. Happy to have you over to our new offices. But we've got a whole podcasting studio, video studio, the whole media thing that cool companies like ours like to put together. We're still putting it together. We got some boxes we're unpacking, but hopefully next week we'll be up and running, and you'll see. So there'll be some small, not really format changes to the flow of the show, but Matt and I are going to be in the same room
Yeah.
because we are in the same office space. He's 20 feet that way. And this is just how we've been setting it up since, before time is doing whether Zoom, Google Meet or whatever. It's easier to kind of produce the show. And this is probably too much inside baseball, but we're going to be doing it live, elevate the production quality over time. So something to look forward to. If you aren't checking out grayreport.com, I highly recommend grayreport.com. And if you're interested in kind of learning about how you can get involved in multifamily apartment investing, invest alongside Great Capital, and proud that I'm a part of the team, but incredible group of investment and real estate professionals. GreatCapitalLLC.com. You can join our investment club and just start the process, do an investment strategy session. Most of our offerings are only open to accredited investors. So if you are an accredited investor, trying to make some more allocations to real estate, you're making your first allocation to commercial real estate, we'd love to have a conversation with you. So greatcapitalllc.com, and looking forward to having that conversation. All right, Matt, see everybody next week.
All right.
Everyone.
See ya. Thanks.